We are still living in an unpredictable economic time. Recently, household debt exceeded $17 trillion, with mortgages, credit cards, and student loans leading the way. Inflation is still higher than the Federal Reserve's target rate of 2%, and a recession in 2024 is still conceivable. This raises the possibility that a real estate market collapse is imminent. Is there an instability in the market for real estate? The Federal Reserve Bank of Dallas noted indications of a brewing U.S. housing bubble. The research concluded that while the notable surge in house prices does not point to a bubble, there are still important aspects to take into account. Among the economic factors contributing to continuous real house price increases are shifts in disposable income, the cost of credit and access to it, supply disruptions, and rising labor and raw material costs. The housing market deviates from these fundamentals when there is widespread belief that today's robust price increases will continue, according to the Dallas Fed report. Purchases motivated by a fear of missing out can raise prices and heighten expectations of strong gains in house prices if a large number of buyers hold to this belief. The deputy chief economist at Freddie Mac, Len Kiefer, disagrees that there is a bubble in the U.S. housing market. According to Kiefer, there are three distinct features of a bubble: price inflation propelled by speculation, credit expansion fueling the bubble, and bubble burst. Even though home prices rose at record rates in 2021, record low mortgage rates and a fundamental shift in housing demand were the main causes of the increase, not credit expansion or speculation. However, what about those whose property values are currently declining, who purchased it either before or during the pandemic? Vice President of mortgage website HSH.com Keith Gumbinger states that if you purchased a house 3 years ago for $300,000, you could have sold it for $500,000 last year, but now it's only worth $400,000. He's not sure if this qualifies as a bubble pop or a crash though. Gumbinger claims it is a paper loss but not an actual loss. How are the elites preparing for the crisis? A downturn may be easier for the many homeowners who have equity in their houses now. Nearly half of mortgaged residential properties in the US are still regarded as equity-rich, which means that the total estimated value of loan balances guaranteed by those properties is at or below 50% of their property value, according to recent statistics from Atom. On the other hand, by the end of 2009, about 25% of American homeowners owed more on their mortgages than their properties were worth, a situation known as underwater or negative equity. A new CoreLogic data states that borrowers' equity decreased 1.7% in Q2 2023 compared to the same period the previous year, on average by $8,700. However, home equity is still strong. Since 2019, the average homeowner's net worth has increased by almost $100,000, according to NAR. Compared to January 2020, the national median existing home price has increased by around 48%. How would the housing market be affected by a recession? A recession is defined by economists at the National Bureau of Economic Research as a protracted period that lasts at least a few months and is characterized by a significant and widespread decline in economic activity. The following are additional indicators that economists look for to determine whether we are approaching or have already entered a recession. GDP experiences 2 consecutive quarters of contraction or decline. High borrowing costs and inflation slow down spending, manufacturing and trade sales slow down, unemployment rises steadily, and there is an inverted yield curve between the 10-year Treasury and short-term bonds. A recession in 2024 was predicted by several economists in 2022, despite a number of warning indicators. By December 2022, the 10-year Treasury and short-term bond yield curves were inverted, which is frequently a sign that recession is approaching, and inflation was still running at a scorching hot 6.5%. The Fed's benchmark lending rate had also increased to a range of 4.25% to 4.5%. A recession may be the deciding factor for rates, but as of right now, the outlook is for a brief, mild recession in 2024, which would not result in a significant decrease in mortgage rates. What do you think about the current real estate crisis? Do you believe that the present crisis will have an impact on you? Do share your thoughts on this in the comments section. For more interesting stories and updates, subscribe to our channel and do not forget to press the bell icon for notifications. Goodbye.